reason for the $3 to $4 trillion of estimate in stablecoins is because it's much more efficient than TradFi and banking rails.
We can assume that users are more crypto native and used to getting this type of exposure in wallets rather than in a new bank.
Casts of the world are just raising a big round and ready to run for a big market. So absolutely, the adoption has happened on the wallet side first. Growth first and then commercialization later.
The customer base it's all quite diverse and it's all in constant motion.
We're all betting that we'll have 100 billion in TVL in our vaults in a couple years' time. So we think cybersecurity is probably the biggest risk we will face in kind of an AI era. I think this is DeFi's last summer. It will not look in any way, shape, or form, call it 5-8 years. It will look more TradFi like, asset management like, compliant.
Hi everyone, and welcome to Onchain Honestly,
a podcast about what actually works in crypto as a business.
We're long-term believers in this space, and we want more honest conversations about what's changing and why.
So we explore real models, practical outcomes, and what it takes to build something that lasts. Today on Onchain Honestly, we are happy to welcome Nicholas Cannon, Chief Business Officer at Gauntlet. Gauntlet is one of the premier yield curators in crypto, helping allocators put their capital to work on chain. There are a few better people to have a conversation about the business of curated DeFi than Nicholas, so welcome to the podcast.
Thanks, excited to be here.
Perhaps to kick things off, we could start more on the internal kitchen side of the whole business. So could you in one sentence describe Gauntlet?
Automated alpha for stablecoins, cryptocurrencies, and tokenized assets. I've been trying to shrink down the tagline because we've done a lot of stuff for 8 years across sectors and categories, from research to, of course, like what we're talking about today is curation. But I think automated alpha for these assets is what we're focused on.
It's actually very interesting because you guys have different positioning on different sources. So we checked, the website, Twitter. Very cool. Nick, so it's obviously all about like on-chain strategies and vault and risk curation. Who exactly designs all those strategies? How many people work on those every single day?
There's about 40 right now. The founders are quants from high frequency trading that 8 years ago started the firm and brought over models and simulations and that kind of economic market stress mindset to early consensus layers and then eventually DeFi protocols. So quant first and then engineers, and of course you're talking to the business side.
All right, so 40 people out of, what's the total number of people?
About 40 right now. Yeah.
So, okay, it's 14 total. I thought you were talking about people responsible for strategies as such.
I would say, strategies, I'd say it's about 28 maybe. Majority of those are quants. So you have the quant layer, we kind of look like a pod shop in some senses. Think of like morpho curation, and then you have derivative strategies and a variety of others. And these kind of sit on their own structured teams where you have a quant and engineers, and then you have kind of the business side facing and the underlying horizontal layers of operations, legal, finance, things like that kind of sit across the org umbrella us all and keep money in the bank and our regulatory posture sound.
Right. No, it's obviously always very interesting, to take a deeper look into how exactly the internal kitchen works. So we'll have a few more questions on that. So I'm really curious how the internal process looks like regarding the launch of a new strategy. Let's say, we can take as an example the recent RWA Vault. I think it was deployed like in Jan of this year, but has really grown pretty recently. And then also if you could talk about the change of the existing vault, right? The allocation within an existing vault. So how does the whole process look like on those in those two scenarios?
Yeah, for vaults and strategies, and specifically like as you hear the kind of the rage around tokenized assets and RWAs, there's not really one trigger. There's maybe three. First would be kind of like a distribution partner with a specific user base and a risk appetite that they haven't served before. So, for example, we run a leverage strategy for Falcon X, where they package their loans on their OTC side, and we use this both with an underlying protocol for treasury management that we created years ago for DAOs, and now used for running structured like products on vaults, and we used Morpho markets on the underlying side to lend into that. So basically, we have a partner in Falcon X that has some demand and users that want to lend into it. And on the other side, kind of how I described the pod shops, we have the Morpho Curation Pod, who has a frontier risk tranche that has stablecoins they can allocate into this strategy. They have a mandate that they can put a certain amount of weight into this of the allocation. And so, kind of, it's at the end of the day a credit marketplace, and you need both sides of it. And fortunately enough, in a lot of cases, we can source the supply and the origination. Uh, Other ways, tokenized assets or RWAs, kind of come on chain, or you see us pop up with a strategy around it, is just a new collateral type. There's a lot of excitement around MicroStrategy Stretch these days. We're diligencing that right now. But as more things start to get tokenized, various tokenized equities on new chains, and with new programs or fintech partners that are bringing them, at the end of the day, it's just a matching problem. As long as Gauntlet can get comfortable with the underwriting, how liquidation mechanism works, the mint redeem, things like that, we will spin up a strategy and again try to automate that alpha. And then sometimes there's a market event that will like expose a gap in existing strategies. You're trying to create something like a yield curve from conservative to more aggressive, and as if we can get comfortable with the volatility that a new asset and the yield that it puts off will provide to the vault, we'll underwrite it and allocate to it and go from there.
Nick, and you also do allocate into vaults curated by other risk curators in the space, right? Because I think I saw like Centaurus, PY used Vault and Aral used Vault as well. I don't think they. I mean, you are still allocating into those at this particular moment, but it could be a way to look at it as well, right?
Yeah, there's no reason not to, right? At the end of the day, like if in some underlying primitive layers on the credit side for Morpho example, for example, we don't necessarily have that choice. Those vaults allocate to markets. But when we run more aggregated like strategies or basket strategies on Era, we of course will look at all yield sources. And if we just have to underwrite a few more things, basically the operator or the curator in that sense, and it's very fine if it's not ours. And this is kind of where I think we have an advantage of separating the concerns of people internally working on morphovault curation versus elsewhere. We're looking for alpha, we're looking for risk adjusted yield, and it doesn't necessarily always have to be in-house where it's generated.
Yeah, I mean, the different distribution strategies have evolved over time for sure, but you also work with various like neobanks, fintechs, custodians. Where or like which sector do you see the most growth or interest in?
Yeah, there's this funny adoption curve where you'll see people. You can kind of see it naturally where more crypto native firms, or you talked about our positioning, and you can see this with fintechs or neobanks or similar. The more crypto native positioning, younger, sort of towards millennial to Gen Z below, if they're positioning more towards an internet and native audience, more stable coins and things like that, that's usually where we'll find quick and immediate distribution, easy onboarding. You're not overcoming legacy systems or ripping out some kind of ACH or existing card like programs or reward programs. So we're working with the likes of CAS and of course a lot of the crypto exchanges or centralized exchanges that are transitioning on chain in a variety of ways, either because of Clarity Act or just because they see that the walled gardens of the future are not really going to hold their users in. We're using bearer assets and they want to be free, and so this is where we're seeing the adoption the quickest. And then you kind of go towards more. custodial like solutions that will be there for compliance or otherwise reasons. Initially, of course, custodians, which as of even this year, from a qualified custodian side of things, you can post collateral into credit markets on chain using oracles, and there's a bit more complexity in the proof of reserve and verifying those assets are off chain in order to be used as collateral on chain. But that's very much a kind of plumbing, a DeFi plumbing unlock that hadn't happened until literally this year. From there, more TradFi asset managers. You see, we've run some strategies for Apollo, and they'll get more active on chain, as well as BlackRock and a variety of others. The ETFs are kind of the first step, and where they go next, you see the on chain, on what do they call these funds? On chain shares or something like that. The money market funds and a lot of things that they can tokenize and run structured products around. And then just the big banks, just TradFi writ large, will very much come. I couldn't put a time on that, but it does seem quicker. And if you see the job descriptions opening up in a flurry this year, I don't think it's going to be too long.
Nick, but can we kind of break it down a bit more in detail? So let's start with retail distribution. So the examples that you mentioned, or that Kaiser has mentioned, are like neobanks, and then I know for sure that you made some integrations with wallets and centralized exchanges, right? So can you maybe name, okay, without calling like companies' names, but still like talking about categories of products, what really worked best? Was it more on the wallet side? Was it more on the exchange side, on neobank? So if we take these three distribution channels as examples.
I think wallets are simplest, right? Naturally, the privies, the turnkeys, anybody building a wallet-like infra solution is creating infra that variety of either neobanks, crypto native apps, or otherwise are already comfortable with basically building out their own on-chain stack. So the next thing you would, of course, do is find a yield solution. You have the wallet kind of solves this self-custody like problem, where do you hold your assets in your app, whether it's a web app, native, or more likely a mobile app, and then what do you do with them to keep those assets on platform or on chain or in a like wallet? Because otherwise, you create some nice use cases, some nice features, payments, remittances, other interactions, gaming or otherwise. But where do those assets and especially stablecoins go when they're at rest? And then how does the platform, the app, or the entity monetize those? And in a lot of cases, we do, the big selling point and the reason for the $3 to $4 trillion of estimate in stablecoins is because it's much more efficient than TradFi and banking rails, and efficient just means cheaper. And so in a lot of cases, how do these platforms make money? It will likely be yield and some percentage of that to keep assets on platform.
Is it the distribution platform that is the one to decide which vault exactly is going to be integrated, or is it on your side?
Sometimes, yeah. So this is very much a design choice. So does the distribution platform say, hey, I think I have a certain audience that is not particularly crypto native or sophisticated investors, and what they're really looking for is just a passive way to have yield on their assets while they're waiting for their other activity. They're waiting for an event to buy or to send money to friends or something like that. And as long as it's reasonably risk adjusted and they don't have to worry about, they're not trying to optimize the last 20 to 30 basis points of yield, then a very conservative strategy is usually what these platforms go for. They don't want a menu of options. This is not the core part of the user experience that they're usually trying to solve for. More sophisticated models, or more like trading, DeFi native, or investment like models, you could say, will start to build out a menu of options, and they'll similarly go from conservative to more aggressive, but it is still a curated set that they'll expose, right? There's thousands of vaults you can expose. You could use a variety of on-chain APIs to touch on dozens of chains and dozens of protocols. Almost nobody wants that, or I haven't seen anybody actually want that. They might integrate it just in one fell swoop to maintain that optionality, but they almost always want a curated experience, minimize their counterparties because there's a a lot of reasons to do that.
Sure. I'm not really sure about the traction numbers on the cast side with the USD Alpha Vault that they've integrated. Not already recently, right? I think it was like winter or something.
Yeah.
But I think it's an amazing opportunity to tap into the RWA exposure for the users of Cast. It's really one of the only solutions I've seen in the market, apart from maybe like exposure to stocks or pre-IPO stocks since recently. So it's, yeah, again, on a personal note, it's amazing. But a very straightforward question. So can you say that distribution across wallets has worked better than across neobanks, at least judging from the experience of Gauntlet so far? Because I mean, we
Yeah.
can assume that like users are more crypto native and more used to getting this type of exposure in wallets rather than in a neobank, probably.
Yeah, and I think you could see this in the acquisitions of like Stripe acquiring Privy and not some, crypto native neobank. It kind of tells in the numbers of where they think that's going and where they've seen it go. You see kind of wallets in a lot of sense already commoditized for good reasons. So there's very good tech and very important tech for self custodying these assets, and but there's a lot of competition and it's quite crowded. Whereas the casts of the world are just raising a big round and ready to run for a big market. So absolutely, the adoption has happened on the wallet side first.
And what would you say about the integration you've made with Wirex? So how does distribution work for, let's say, B2B clients for enterprises that Wirex serves?
Gauntlet very much sees WireX and similar distribution partners as quite critical to growing our business. At the end of the day, we're a small startup, and we think we have a good moat and ability to drive value on the quantitative risk side. But there's a lot of other layers in the stack, and going B2B to B is the most interesting at the end of the day. And bigger liquidity pools and more sticky enterprise use cases are what's most interesting to us. This is why we find custodians so interesting, and similar like partners. We can build enterprise like solutions, APIs, and SDKs that are separate. The on-chain smart contracts and the permissions and the roles that we work and kind of really try to solidify around, because we know these demand kind of pulls, both on the supply side and the origination side, will not be as cyclical as we see with retail.
I think it will be extremely interesting to compare the metrics for every integration that we touched upon. Maybe we'll follow up with you to extract a bit more value from you in terms of really practical numbers. Just seeing how traction that you recently got from like Wirex integration compares to whatever, like Cast or like on the retail side, right? And then on the institutional side for Anchorage as well, if those numbers are publicly available, of course.
In a lot of cases, they are. And like, what's interesting about Cast or WireX or others is they can use public existing vaults. In a lot of cases, they do, right? So Cast, for example, uses the Gauntlet USD Alpha Vault, as do I, for example, personally, as do plenty of others. So they benefit from that liquidity and kind of the amortization of like Gauntlet's best quant team as these vaults get bigger and have more attention. We of course want more robust monitoring, discretionary, overrides and global coverage and things like that as well. But they can also customize it with wrapper vaults.
Nick, and do I understand correctly that you originally operated obviously as your own proprietary marketplace or platform with vaults? Obviously showing those vaults on Morpho, let's say, in Camino and other lending platforms that you allocate across. But when did you start those integrations onto external platforms exactly? And can you maybe again name a particular category of platforms that you've seen most growth across? Like just one, maybe one integration that really, brought you from zero to one.
We've had Morpho vaults for a little over 2 years now. The first year was primarily dominated by natural on-chain demand. This is both retail and high net worth individuals. In the past little over a year, you've seen these what you'd consider B2B integrations, Web 2 and off-chain like integrations. And absolutely the dominant category has been wallets. Wallets are are, of course, in a competitive fight right now. A lot of them are launching stable coins. They're trying to keep and maintain their users, which is very hard with cryptocurrencies and bearer assets that don't have banking hours or walled gardens. And they need to either reach feature parity with their competition or have some, above and beyond offerings. And absolutely vaults and kind of the yield that we and others generate on those have been the biggest driver. Millions of users, a lot of which are those early adopters, retail and high net worth individuals that are maybe only one step adjacent or one adoption concentric circle beyond the kind of hardware wallet, fully self custodied off chain like user, a little slightly less sophisticated, but that's where we've seen it so far in this past year. That's as far as the dominant integration category.
And maybe when we are on the topic, we could also touch upon the business model a little bit. So if you could describe what are Gauntlet's main revenue streams today?
8 years ago, it was advisory, primarily on the economic and market side. I used to explain like business model was very boring. When I showed up in 2021, we were doing 30-page PDFs with stress tests and very static like outputs, which people found valuable. L1s found valuable for consensus consideration. DeFi protocols found valuable for liquidation and other parameterization. But the static nature of a PDF is not particularly useful in the dynamic environment of on-chain. And so we moved to more dynamic risk management optimization for Aave and Uniswap and DAOs and foundations. And as mentioned, what the primary driver of the commercial model is today is fees on vaults. So there's performance fees and there's vault-like fees, either via wrapper or otherwise. And these are just the operational complexities of managing it. We are very much in like a growth stage, and you'll see this across the board for us and others, where we're all betting that the market will get considerably bigger. And so I'd argue that majority of vaults haven't seen an equilibrium of where the fees, both vault and TVL and operational fees, will land exactly, because we're all trying to bet on growth and liquidity, and getting that liquidity now and market share now very much matters.
Nick, and I think as far as I saw on Gauntlet's platform as of yesterday, the performance fees on most vaults, and I think I checked the major ones really, are essentially zero. So is it done on purpose? Have you been doing it for a while already? What's the reasoning behind it?
Yeah, absolutely intentional. I don't think that'll change over time. Performance fees right now wouldn't make a lot of sense, charging 10, 15, 25 bips on prime like vaults while we're in this very uncertain stage of growth. You can call it a land grab or growth of market share, but aggregating liquidity, this is not like a competitive secret. It is of course quite advantageous for creating other strategies, for climbing leaderboards and being more visible in a sector that largely no one knows anybody for, not just us but everyone else curating. These models on chain didn't exist, or these commercial like models didn't exist a couple years ago. Of course, us and plenty of others have done other advisory like services, or been around the space for a while, but it's absolutely changed. So growth first, and then commercialization later.
And then does your business model change depending on the partner you're integrating with? Because I assume you do charge something on top if we're talking about the particular integration with all those players that we've mentioned previously.
Yeah, it depends on what all we're doing for them. So sometimes it is just a simple vault. You plug and play, you get the vault and the fee that it is on chain. We're happy to get liquidity. We can give some additional support for reporting and program management and things like that as needed. But you'll see even with like the Coinbase integration, that when they have captive demand or captive supply, they're very comfortable charging more. So that's the kind of tricky thing about vault fees on chain. In a lot of cases with the integrations, what you see is not what you get, or doesn't go to the end curator or the end user necessarily. It might go to the protocol. It might go to the curator. or in most cases, as you'd imagine, whoever's driving that demand or supply is capturing the majority of those fees. And as they very much are, they still, for all intents and purposes, or most intents and purposes, own that user.
And what are the profit margins in this market in general? If you could comment on that, maybe at least a range.
Yeah, I don't think anyone's solving for profit. Like, because I thought about this a lot. I think about it from our side. Uh, we're all betting that we'll have 100 billion in TVL in our vaults in a couple years' time. And so, what does that mean for the platform that we need to build out, both on the security, the legal side, the infra side? And we need to think about how to amortize those costs over time. So it's quite capital intensive upfront. But if we're coming behind this tailwind, so to speak, of not just tokenized assets but stable coins. This is the bet I think we're making, and I would definitely think a lot of our competitors are.
Have you raised, by the way?
We historically, yes, we raised our last round was Series B in 20 end of 2021, just before FTX, so maybe good timing. But in total, we've raised about 45 million.
Okay, and I mean, you're still at, growth scaling stage, but again, being like number three right now after Steakhouses in Tora, I think last time I checked.
Yeah, it's interesting because I have all the respect in the world for DeFi Llama. I've been in DeFi for
Yeah,
eight
that's
years.
definitely from DeFi Lamy, right?
Yeah, absolutely, and it's interesting because of course DeFi Llama ranks protocols, right? That's the natural sorting, even what they say, and obviously none of the people you spoke about are protocols, and majority of our fees, I'm very confident Centaura and Steakhouses are off chain as well, and those splits that you see on chain are also not. So that it's kind of reading into what it can, as DeFi Llama should. It's always quite objective to see like, hey, this is what the smart contract says. This is where the fees are being generated and split. This is what the TVL looks like. But those three and the long list of like 10 you'll see on that curator list are actually have very different business models, both either advisory, kind of CFO like functions. A lot of them have hedge funds and separate entities. And Gauntlet has a few up our sleeves as well.
But what I can say for sure is that you have the largest number of integrations, at least what I'm seeing in the market. That's for sure in terms of partners you work with.
Yeah, I'd say that probably tracks. And something we've tried to do to lower that friction is the affiliate program, which is not your standard, like, there's no points, there's nothing like that. But it's basically a self-serve like vault model. What we found is a lot of people were integrating us just by finding our vault either on some public platform. Of course, there's smart contracts, and they can allocate supply to. But we give a little bit more support and have a bit more structure of a B2B model that helps them tier up to something more like enterprise that you've talked about with the exchanges or WireX or whoever else. And this gives us visibility and be able to forecast and then kind of invest on the platform side into supporting them, because they don't just need the vault, right? They have users that have different use cases that they need to surface in UI, UXs, reporting, compliance, things like that. And so we're trying to get better visibility into it because it's, of course, extremely hard in crypto and on chain. Who are your users? You can see the TVL or the size, but that's about it. So the closer we can get to who is driving that demand, kind of to your point, is it wallets? What is that next wave? We can build a better solution, which is not just the yield or the risk adjusted yield or the alpha, but it's all everything that wraps around that.
You've mentioned now several times that the customer base is it's all quite diverse and it's all in constant motion. So how has that impacted the way you create your strategy?
Super important. So we think a lot about supply side and demand side diversification, just because from a risk perspective, the more concentrated it is, the more volatility you're going to be exposed to, right? If one big borrower closes their position, yield will crash. If one big supplier pulls their position, liquidity could be max utilized, and people could be locked up. And so we've done a lot of work both on the like the BD and partnership side to make sure that that supply base and that integration base is diversified. And you can kind of see this in the numbers publicly. Like our vaults are actually the most diversified. We have last time I checked, like 10 to 15 times as many people using two vaults compared to others. So basically, there's some kind of brand loyalty, but we can also see the traction across different risk profiles and risk tiers, and that very much matters. Uh, so that matters, of course, for growth, but in revenue and all those good things. But it matters to lower the risk profile and smooth out that rate, which at the end of the day is still variable in most cases on chain, block by block, and people don't love that. They want to know what their rate is. They want to, in a lot of cases, set it and forget it. And if it doubles one day and it's half the next day, that's not particularly ideal. Cast and others have to explain to their users what's going on, and that creates a lot of customer support tickets.
And building on this, I'm very curious in the RWA side of your strategy and of your current vision, because you definitely started to be active on that side recently. So you mentioned the accurate vault that you did with together with Securitize, and I mean originally that's Apollo's asset, right? So there is a separate RWA vault that we already touched upon that I think you first deployed in January of this year. But we all understand that RWAs as an asset class in DeFi holds a large range of risks, including the duration gap and lack of liquidity, um, etc., etc. Like, I mean, the list is super long. So what's your current positioning on that? Because again, there are players in the risk curation market that I think are a bit more active maybe on that side, like take Rockaway X, that's become, maybe the major risk curator for different RWA assets, at least in the Solana ecosystem. So again, what's your stance there?
We're intentionally slow. I was talking to a few big banks, I don't know, during Digital Asset Week when they're in New York, and they go, "Oh, we can miss the $3 trillion crypto market, but we can't miss the, you know, trillions more of tokenized assets." And this is kind of how we think about it. There's a lot of plumbing, both in our experience of, Securitized Apollo and others, as well as what we see in the market that needs to be sorted out to get confident in how we underwrite these things for a 24/7 global like market with a various amount of actors and vaults and things. Our RWA tokenized asset diligence is literally the form is 10 times longer and takes a few weeks longer, and that's intentional, both on the standard credit underwriting stuff that exists off chain, side letters, governance, things like that. But on chain, like how do you think about mint redeem? What are the flows? We do a lot of tests of those ourselves. How do we unwind these flows, and similar. I think what the governance structures are quite unique, and there is no standard, which is kind of a nightmare, both from the end user who wants to use this asset or allocate into it and understand what exposure they're actually getting, and then from, of course, just us like trying to risk manage it. How do we explain that we have 20 different RWAs from 10 different issuers in a variety of jurisdictions, and the governance structures are quite different. So I think there's starting to be more standards, which gets us exciting. I'm not worried we're going to miss it or anything like that. But it's super important to make sure we have all weather like vaults. As you see, DeFi rates are extremely compressed because leverage or borrow demand against BTC and ETH and you know native cryptocurrencies is not as high as it was in Q3, Q4 last year. But for a lot of tokenized assets, this is quite appealing. And again, back to the rates and the yield you can generate, the smoother you can make that across the board, the more demand, consistent demand we think we can drive.
Fair enough. But since you again mentioned the this experiment that you made together with Securitize and Apollo, Apollo is one of the largest global asset managers, definitely tapping into the tokenization space, which is great news for everyone operating here. But what is your opinion on the, let's say, long-term perspective here in terms of the role of risk curators, like crypto native DeFi risk curators for global asset managers, would they still be resorting to you to tap into your services in terms of on-chain risk curation, or do you think they will be launching their own strategies, maybe even their own infrastructure? Because again, for now, they are making these small experiments with existing established players in the crypto space. But what about the long term?
Yeah, I think you're estimating like probably like I am that this will change, right? Like they're not trying to give a free lunch to Gauntlet while they have $1 trillion of assets under management and they can't figure out how to buy 40 quants that can figure out smart contracts and make sure North Korea doesn't hack them. But I do think there will be a blend for the foreseeable future where they'll use some of our strategies, then they'll asset manage or post collateral themselves and get more active. And a lot will have internal platforms themselves and run strategies that are off chain. And this is kind of a bit back to my point of like public metrics, DeFi Llama, things like that. This exists already. I think there's a lot of strategies and vaults that you actually don't see posted anywhere. There's no one has a motivation to expose what strategy they're running on chain for a lot of reasons. One, because they are generating the revenue off chain, but historically, why you would want to be on DeFi Llama is because you had a token and you wanted to show that you had growth and you hoped people bought that token. But us and the Apollos of the world don't have that token, or the Apollo ticker is off chain for the most part, and so it's not a particular concern. So I think you'll see a combination of flavors.
Nick, and there's one more thing without which we can't really let you go. It's definitely the recent incidents, the recent hacks that the industry has unfortunately seen. Resolve, Drift, and Calp DAO. I know that, again, at least as far as I know, you did have exposure within the first incident, but then the second and third went quite well, if we can say so, for you. So could you please comment on that, maybe just briefly covering the details of each? But the major question is essentially how exactly it changed your strategy to risk curation.
Yeah, so there was a short sequence of very big hacks. Of course, Gauntlet has 80 vaults and had some exposure, as we would expect if a hack happens in a lending and credit market or touches a lending and credit market, we should probably have some exposure, which we did. So then it goes into how our run books and risk off responses work accordingly. As you mentioned, kelp worked really well. We had very minimal exposure to that. I think 10 ETH at cap and automated risk off um, saw the exploit happening and was able to allocate out, no exposure. Drift, we'd actually unwound a lot of our basis trade strategies as a result. So for better or worse, these are our self-custodial strategies. So people still had funds in Drift, unfortunately, and there's still a remediation path for Resolve super interesting because, and maybe similar to Kelp that Ave of course had majority of the exposure to, is when these mints or attacks happened, unauthorized mints, illicit mints, they would call them. There's not enough liquidity on chain to swap into a stable coin or ETH or an asset they can get away with the hacker, and so they go to these lending markets to get stable coins or an asset that they can very much. In Resolve's case, we had some exposure in our more aggressive vaults and started to allocate those away. Morpho has this interesting function called the public allocator, which there's a lot of curators and there's a lot of different vaults, and the summation of that is that this can fragment liquidity and create like a problematic user experience for the protocol, right? If you think compared to Aave and bigger pooled models, they have a bunch of liquidity, so a big borrower and supplier can come in and again to the rate volatility, not affect that as much. The public allocator, which we have on and others usually do as well, reallocated to some of the Resolve hacker and more importantly, like Meb bots that were arbitraging the DEX prices that had crashed. There's also this interesting dynamic, which I think Morpho and other protocols are upgrading. these are credit protocols, these are lending protocols, and in TradFi, impairments or losses happen all the time, right? 1%, 5%, something like that. They literally happen daily. They're not particularly news. And what's important about that is they don't create runs on the protocol or the bank or whatever it might be. Currently, the incentive structure is not aligned to do so. A lot of borrowers, or sorry, a lot of suppliers that had exposure in our vaults and elsewhere were able to just withdraw after the attack without any sort of impairment. So it kind of creates this weird incentive structure where you can call it MEV, you can call it front running, but if you're monitoring your position because you're more active, something like a trader, lending and looking for yield, you can actually do that today. Even we're talking today, May 25th. How many weeks after? You can still withdraw from the frontier vaults without any impairment, even though a resolve resolution, which we just received, will roll out next week or this coming week. To pay that back. And we actually need to wait for the Frontier Vault to become illiquid in order to do so. And then unfortunately, a lot of that loss will be socialized. So there's a lot of design and at the protocol level that needs to get fixed if we want to have credit markets and go down the risk curve. All that to say, what's changed for Gauntlet? Of course, security is super important. We've had a head of security for about 2.5 years now. That's a one-man show historically, but now it's very much more. We're of course, hiring more people to do so. We've had a number of external security vendors, Chainalysis and Zero Shadow and Hypernative and all these things. We're starting to expose less of that though, counterintuitively. Whereas we want to show to on podcasts and to users that we have a very tight security posture, but we also don't want to expose all of our surface area. We want to say we're taking this quite seriously. We're investing significant portion of our treasury and our resources and our hiring to do so. But we don't want to talk too much about it because we think cybersecurity is probably the biggest risk we will face in kind of an AI era, at least for the next year or two. As much as we want to think our mode is the quant and economic and market risk side, we need to make sure that principal does not go to zero, and the people who supply to our vaults are quite safe. And I think we have a good posture to do so, but we've got to stay diligent, obviously.
But what were the direct effects of that particular incident? Have you seen an outflow of funds or, maybe decreased interest of the partners you were talking to at that time?
No, yeah, natural outflow funds of the vaults that we deprecated. So again, so a bit of what you have to do is remove markets and then migrate. So yeah, naturally there. Elsewhere, like Prime and conservative Prime, which is our more conservative vaults, actually saw some inflows. Partners, no. Partners very much understand security and what they're signing up for. If anything, originally when after 10/10, for example, when there was a big flash crash and kind of the market died for a hot second there, Phantom, who was operating some of their own Camino vaults, immediately moved to us as a risk curator because while they felt like, oh, we can kind of do this, this is a simple strategy, we don't need to overthink this. You very much realize like there's the edge cases is where curators and people like us actually try to provide a ton of value. So yeah, you see the ebbs and flows of the market. Most of the market post resolve, post drift, post kelp was very risk off. You still see this in the numbers today, but the integration partners and fintechs and neobanks and wallets and B2B very much still marching forward, maybe with a little bit more due diligence during the integration phase.
And maybe just to wrap up slowly this episode, from your perspective, what are the three most important steps that DeFi infrastructure and asset management players need to take to make the space safer and more institutionally acceptable?
I think you'll see one pretty quickly in ratings. We had ratings on DeFi Pulse, which is the predecessor to DeFi Llama, about 6, 7 years ago. Too early, could only do it at the protocol level. There was no vaults, of course, but S&P and others that very much can translate a simple rating system into TradFi, and institutional allocators will very much matter. Uh, I think we over-index as an industry on infrastructure. There was always like the fat protocol thesis or blockchains and tokens, and of course we see that. We actually, I think people just want use cases that are safe and compliant, that touch their end users end to end, and they don't have to think about composable Legos that historically we're all like, super excited to build with. But they have a lot of other things that they're trying to do, and their user stories or their user experiences don't aren't wrapped up in these very customizable orchestration like effects. They kind of want a conductor. And so end-to-end solutions, I think, are super important. I don't think they're aggregators or infrastructure like plays. Um, and then the last one is just always going to be regulatory clarity. I was in APAC in Tokyo specifically last week, and I was absolutely floored by how closely they watch the Senate floor and the clarity bill in the States, much closer than I do. I just kind of assume and wait. When it comes, it comes. Or when my general counsel says we need to change our strategy or sales proposals or website comms or something like that. But the U.S. Clarity Act and what makes or comes of that will very much change at least how Asia is going to operate this year.
Same here in Dubai. All eyes are, yeah, on the Senate floor these days. Nick, and on the very, very concluding note, I hate this type of questions because they're very broad and theoretical, but I can't really, help asking you that. How do you see the future of risk curation? Because again, you mentioned that we're very uncertain about what moves global asset managers will make, right? Whether they will be running their own infra in a matter of what, like a few months or years. So how do you see the future of Gauntlet in this space? I really want our listeners to, to stay with a clear picture in their heads, let's say.
I think this is DeFi's last summer. It's final table. It will not look in any way, shape, or form like it has for the past, call it 5, 8 years, next summer or something like that. It will, for the early adopters, they'll be kind of sad. It will look more TradFi like, asset management like, compliant. We won't talk about the philosophical nature of the token and things like that. Uh, where does Gauntlet go? We kind of go towards that bigger pool of capital. We are not a B2C company. We're not trying to make a mobile app. I don't envy those trying, and but asset management needs to get extremely big, and vaults I think can track towards that with stablecoins and tokenized assets.
I think I just came up with the title for this episode, the last DeFi summer. What do you think about it?
Yes, I was thinking exactly the same. That great way to wrap up this episode.
Thank you so much for your time.
I had fun. Hope your listeners do as well.